Welcome to our third episode of RSM Audit Unlocked, where we're so excited to have you joining us once again. I'm Jess, a director in the RSM Brisbane office, where it's always sunny.
And I'm Amy. I'm a partner in the Melbourne office, where the coffee's strong and the audits are even stronger.
And sassier. So today, Amy, we have the juicy topic of going concern.
I'm excited about this
I know you're excited about this one. It applies to all companies, so let's get straight into it. It's going to be a good one. So let's start with the basics. Tell me about what is the going concern assumption?
Okay, going concern assumption and principle is that it assumes that a business will be able to continue for the foreseeable future. So 12 months from the date of signing off the financial statements. So look, it's crucial for financial reporting, for transparency, underpins the reliability of the financial statements. And if the company are not going concern, then the financial statements will look a little bit different, not prepared on a going concern basis, and likely that our audit report would have a qualification in there as well.
Yeah, so it's a pretty big topic. It obviously has a lot of impacts on the financials, the audit opinion.
Yep.
I suppose one of the big things we sort of hear is, what's this term material uncertainty? So how does it impact the financial statements? What is it? And how does it impact what's disclosed in the financials?
Great question, Jess.
I know.
Love the material uncertainty.
I know you
not. Unfortunately, it's more common than you would actually think with companies. So the Australian Accounting Standards refers to where there is a significant doubt that a business can continue as a going concern for the foreseeable future. So generally, we see material uncertainty for fairly new startup companies where there's going concern indicators and there might be pre-revenue generating. So what does it mean for the financials and the audit report? That you would have going concern disclosures. So that would outline there's going concern indicators of X, Y, and Z, but the directors believe that there were going concern because of certain factors like capital raises, etc. But what it means in the audit report is that you have, in our audit reports, we have a material uncertainty paragraph, which highlights that there's a material uncertainty and refers back to the note within the financials.
Yeah, great. And can you give us an example of when a material uncertainty would be triggered?
Yep, definitely. So as I mentioned, it's quite common for tech startups like small ASX listed small caps. And look, I think when we're reviewing the forecast of the company, we know that there's going concern indicators, but the forecast might include a capital raise, what's going to happen or expected to happen in the next 6 months, but it's not locked in. The companies are reliant on it. And if they don't get the capital raise, then it means that there is a big question around the going concern of the company.
Yeah, I think that's a really common one that we see a lot as well.
Yeah, absolutely.
And I think it's really important to sort of unpack, what are some of the signs that a business may not be able to continue as a going concern from an auditor's perspective? Amy, we're talking the red flags. What are they?
Oh, well, luckily I'm wearing red, Jess.
I know, convenient.
So, yeah. Okay. First big red flag that we'd look at when reviewing the financials as an auditor is their operating losses. Is there operating cash outflows? Because if a company is not generating cash, big red flag, because obviously cash is king, as we all know. Working capital deficiency, where current liabilities are greater than current assets, really shows that the company is under financial pressure. Other common red flags will be things such as clients having significant unpaid creditors, such as tax liabilities, payroll taxes. Do they have any illiquid current assets, such as slow-moving stock? Do they have debtors what are uncollectible and minimal cash reserves? And don't forget if there is any breaches of the current debt covenants, and any loans that might be up for renewal, where we don't have any other option of being able to renegotiate these, or not really any options to raise capital as well.
Yeah, and what about some of the ratios? What are some of the key ratios we look at?
key ratios for me is really around the interest cover, looking at like EBITDA margins, as well as the debt to equity ratio.
Yeah. I think that's so many different flags to be looking out for as you're going. And I think you've also missed like one of the key areas, some non-financial points. So, you know, is the client losing customers? Is there a major supplier that's like in administration so they can't get their product? Do they have any legal like matters outstanding? So there might be a claim or litigation against them. And let's not forget the old fear of another global pandemic of COVID.
That had a massive impact on, sometimes positive, but a lot of the time, really negative impacts on companies.
Yeah, we saw a lot of companies struggle through that. And all those things can really raise doubts around whether an entity continues as a going concern. So you've been involved in obviously hundreds of audits over the years.
Yeah, so few.
True that. What are some of the most common pitfalls that you see when it comes to going concern? There's often this myth like it's the auditor's responsibility to like work through going concern, but that's not quite true, is it?
No, that's probably where you're going wrong right at the start because it's not our responsibility. It's management's primary responsibility that they're providing us assessment that they are a going concern at the end of the financial reporting period. So the main issues that we do come across when we're reviewing a company's going concern and undertaking the audit procedures, so would be the biggest issue if there's no forecast prepared at all.
Yes.
And there's no formal assessment around going concern that we can review as auditors. The forecasts have been rushed a few days in before signing, and we've only just been provided the forecast just as we're signing. Given that it's a significant risk, we like to get into that early and really have those conversations with management just so we understand what the disclosures and the audit opinion will look like.
And I think one of the issues for that like timing issue is that people have given you their budget for the year. So, you know, a budget's normally based on their calendar year as opposed to looking out for 12 months from the date you're signing the accounts.
Yeah, absolutely.
So it's a rush at the end, you know, add the extras in, consider actuals.
And if you don't have detailed assumptions behind that, not a hard-coded forecast, what we don't really understand what it's based on, if there's no detailed assumptions, it makes our job really hard. Sometimes if the directors are not across management's assessment and they agree with management's assessment, that can also make it really hard as well. Yeah.
And you keep mentioning this like term, sufficient audit evidence. Can you give us some examples of like what is sufficient audit evidence?
Well, we also mentioned around the forecast and really, do they have a good sales pipeline where they've got signed contracts in place that we can verify the sales figure in the forecast? Do they have any capital raises already locked in? Any convertible notes, what's already been signed? They're kind of the real main ones. But also a letter of support from the parent entity. That's a really good level of audit evidence so we can conclude we're comfortable with the going concern of the company.
And with that parent support letter, it's really important to, you know, make sure the parent can actually provide that support as well.
Exactly. So you say when you get to that level, then you say, well, do the financial statements of the parent company, do they actually have cash and working capital to be able to support it as well?
Correct.
That's also a big...
No point of going concern entity providing support for another going concern entity.
Absolutely.
Yeah. Thanks for that little summary. So in a perfect world then, like as an auditor, what do you want to see management providing?
Love a three-way forecast,
of course,
which is all linked, and detailed, and then that forecast might have detailed schedules behind it to see where the numbers come from. And they might stress test the forecast as well. Providing the forecast from day one of the audit is always good, and having a formal assessment around going concern so that we can take that, we can look at the forecast, and it all links together. It's a clear picture. And then we look at the actual results post year end, and it all ties together, makes sense. And the conclusion management have drawn is all great, and we're comfortable with the disclosures in the financial statements. And
I think it's also important to mention the responsibility of the those charged with governance. So at the end of the day, it's going to be the board signing off on the going concern assumption. This bloody bird.
That's what happens.
Real life filming. But no, I think like the board of directors at the end of the day, they're signing off on the entity being a going concern, able to, continue into the future. So they should be really stress testing with management, like what is management's assumptions and are they comfortable that they are reasonable and are they comfortable with the wording that's in the financials?
Yeah, exactly. They play a critical role. And if they're not comfortable with the disclosures and the disclosures are misleading stakeholders, then that's where there might be legal proceedings and like major issues where the directors and maybe even the auditors could get sued as a result of incorrect conclusions around going concern. Not going to mention it in detail, but safe harbour provisions, always a hot tip for directors, especially if companies are in not a strong going concern position. So that's a wrap for this episode. If you do have any questions off the back of the series today or anything else that you've listened to so far, please reach out to me or Jess. We'd love to hear from you. If you found the episode helpful, we'd really appreciate you sharing it with anyone who you might think might benefit from it. Our next episode is a great one. So we'll be unpacking top tips around capitalisation and E&E assets. So it's set to drop next month. So keep an eye out. Thanks for tuning in. See you next time.
See you next time.